Welcome to Talk Tickers.
Glad to be here for this one.
It is Wednesday, February 25, 2026. And usually, when we sit down and turn on these microphones, we are looking at the scorecard.
Right, the earnings transcripts.
Exactly. We are looking at the earnings calls. We're dissecting the EPS. We're looking at the guidance, or trying to figure out if a CFO is maybe hiding some margin compression deep in the footnotes. We spend all our time analyzing the players.
The players and the stats.
Yeah. But for this deep dive, we are doing something entirely different. We aren't looking at the players today. We are looking at the field itself. We're looking at the actual turf we are playing on.
Which is the plumbing of the stock market.
The infrastructure. And look, I know that the moment you say words like infrastructure or plumbing, half the audience is probably reaching for the skip button.
Oh, absolutely. It sounds incredibly dry.
But don't do that, because our topic today is fractional share investing. And while that sounds like a very distinct small feature on your brokerage app,
a nice little UI convenience.
Yeah, exactly. A UI convenience where you can buy a slice of a stock for $1. It is actually a massive structural shift that is, right now, straining the very backbone of the U.S. financial system.
I mean, straining might actually be a polite word for what we are seeing behind the scenes.
It really might be. And we are covering this today, right now, because of a very specific deadline that hit this week. As of this week, February 2026, new mandates from FINRA regarding 6-decimal reporting have just gone live.
Right.
And again, that sounds incredibly boring, 6-decimal reporting. It sounds like something an accountant mutters to put you to sleep. But you're telling me this is actually a smoking gun.
It is absolutely a smoking gun. Think of it this way. For the last decade or so, we have seen this massive celebrated democratization of finance.
Robinhood, Webull, all the fintechs.
Exactly. You can jump on your phone and buy a tiny sliver of Amazon for $5.
Yes.
You can buy a fraction of Berkshire Hathaway. It looks completely seamless on your screen.
It feels like you're just buying a regular stock.
It does. But beneath the surface, the central clearing systems of the United States, the massive machinery that actually legally says, I own this and you sold that, it does not speak that language.
It doesn't speak decimals.
No, it speaks in whole numbers. It strictly speaks in integers. So this week, for the very first time, regulators are stepping in and forcing brokers to report the gap.
The gap between the app and the reality.
Yes. They are forcing them to document down to 6 decimal places exactly how disconnected the front-end user experience is from the back-end clearing reality.
So effectively, the regulator is looking at the industry and saying, we know your plumbing is leaking, and now we are forcing you to measure the exact size of the puddle.
That is a very apt analogy, and the puddle is getting bigger every single day.
Okay, so let's lay out the roadmap for this deep dive. We are going to completely deconstruct this.
Start from the bottom up.
Right. We will move from the basic definition, which I think most of you probably know, to this bizarre 2-tier accounting system that is actually running the show behind your screen.
Which is fascinating all on its own.
And then we need to get into the risks, specifically the hidden risks that definitely aren't in the glossy marketing brochure. Things like the liquidity constraints and the thing we're calling the Roach Motel problem.
Where you can check in, but you really can't check out.
Exactly. And we are going to break down a nightmare scenario regarding corporate actions. There's a specific exploit we'll discuss where traders actually generated free money by gaming these fractional rounding errors.
Well, the Roundup exploit,
Yeah.
I have to say, that is my favorite part of this whole story because it just shows exactly how fragile the underlying math really is.
It's like a heist movie. And finally, we will look at how the pros use this, because despite all the mess and the plumbing issues, there is a massive strategic reason wealthy investors are using fractions for things like direct indexing.
It's not just for $50 accounts.
Not at all. But let's start right at the beginning. Part 1, the evolution of access. Because, it wasn't always this easy to lose money in the stock market.
No, it definitely wasn't. It used to be quite difficult to even get a seat at the table.
You needed real capital.
Right. If you go back 20 or 30 years, or honestly, even just look at the market structure, right before the massive fintech boom of the 2010s, the primary barrier to entry was literally just the share price itself.
We call it the velvet rope of Wall Street.
The velvet rope is real. And the most famous example, the one everyone points to, is Berkshire Hathaway Class A shares.
Right, Warren Buffett.
Warren Buffett, the Oracle of Omaha, famously refused to split that stock, ever.
Yeah.
He didn't want day traders jumping in and out on technical momentum.
He wanted long-term partners.
Exactly. So that stock trades at $400,000, $500,000, sometimes over $600,000 for one single share.
Which Acts as a massive binary filter.
Perfectly said. You either have $500,000 in liquid cash to invest in one single company, or you have zero exposure to it. There was no middle ground.
And while Berkshire is obviously the extreme example, this was a general rule for a very long time across the market.
It really was.
I mean, I remember before the recent wave of tech stock splits, when Amazon and Google were trading around $2,000 or $3,000 a share, buying a proper position in those high-quality tech stocks was a very serious capital commitment for a normal retail investor.
And that ties into the legacy of the round lot. We really need to define the round lot because this is crucial to understanding why the plumbing is breaking today.
Go for it.
The entire U.S. stock market was historically built on the concept of 100 shares. That 100-share block is a round lot. That was the atomic unit of trade for the institutions.
So if you trade 100 shares, the system treats you normally.
Right. You are part of the main flow. But if you trade anything less than that, say you want to buy 17 shares or 42 shares, you are classified as an odd lot.
It literally sounds derogatory. Here come the odd lots.
And it was treated that way by the market makers. In the old days, odd lots were actively handled differently. They were often matched manually or sent off to a completely separate queue.
You essentially got worse pricing.
You absolutely got worse pricing. You were considered a nuisance. The system was optimized for high-speed efficiency, and efficiency meant big, uniform blocks. If you were a retail guy just trying to buy $500 worth of a $20 stock, you were literally clogging up the pipes.
So the solution to this, which was heavily driven by platforms like Robinhood and the subsequent fintechs, was to essentially invert the math of investing.
Yes. Instead of buying by the share count, you now buy by the dollar amount.
It's a shift from quantity to value. You don't log in and say, I want 10 shares of Apple. You say, I want to invest $1,000 into Apple.
And the back-end algorithm just does the math. If the share price happens to be $150, the math says you get exactly 6.666 shares.
And this gets marketed heavily to the public as democratization. And to be completely fair to the brokers, it is. It allows a kid with $50 to actually own a piece of the S&P 500.
The benefits for the retail investor are undeniable. First and foremost, it completely solves the diversification problem.
How so?
Well, previously, if you had a very small account, let's say you managed to save up $2,000, and you bought one single share of Google when it was trading at $1,800, you were done.
Right. Your portfolio is now 90% Google.
Exactly. If Google happened to have one bad quarter, your entire net worth was wiped out. You literally couldn't afford to buy a diversified basket of stocks.
But now, with fractional shares, that exact same $2,000 can be sliced up and split across 30 or 40 different stocks.
You can essentially build a personal, highly customized ETF from scratch.
It also enables precise dollar cost averaging, which frankly is the only way most normal people can actually build wealth.
Yeah, DCA is huge here. You get your paycheck every 2 weeks, and you automatically put $25 or $100 in.
You don't have to wait 3 months to save up enough cash for one full share of a volatile high-priced stock. You just constantly drip the money into the market.
And we have actually seen this behavioral shift impact the raw market data. We call it the retail wave.
The collective power of the small accounts.
Right. Going back to Berkshire Class A for a second, there was this truly fascinating anomaly in the data a few years ago when fractional trading really took off.
What happened?
Historically, Berkshire Class A traded maybe 375, maybe 400 shares a day on average. It's a very sleepy, slow-moving ticker because the price was so astronomical.
Right.
Then, suddenly, the daily volume spiked to over 2,000 shares a day.
Which is insane for a $500,000 asset. That's billions of dollars in daily volume appearing out of nowhere.
But the secret was, it wasn't billions in new, fresh capital. It was fractional shares hitting the tape. The retail platforms were aggregating thousands of these tiny $5 and $10 buy orders and executing them.
So suddenly, the phantom volume of everyday retail investors became visible in the hardest to reach, most expensive asset in the entire market.
It proved without a doubt that collectively, the fractional investor is a massive whale. We saw the same thing during the meme stock craze with GameStop and Tesla. Fractional access vastly amplified the demand and the crazy price swings.
Okay, so that is the what? It's access, it's democratization, it's nice. But now I really want to get into the how.
Because this is where the story stops being a friendly marketing pamphlet and starts being a financial detective novel.
Exactly. You mentioned earlier that the central clearing systems simply don't speak decimals.
They do not.
So when I open my brokerage app right now and the screen clearly says I own 0.5 shares of Apple, surely I own 0.5 shares of Apple, right?
Well, that depends entirely on how you define the word own.
I mean, I paid cash for it. It's sitting there on my screen. If the price of Apple goes up, my account balance goes up, I make money.
You absolutely have economic exposure. You have what the industry calls a beneficial interest. But do you have actual record ownership at the Depository Trust and Clearing Corporation?
The DTCC.
Right, the DTCC, no. You do not. The DTCC only knows whole numbers. The National Securities Clearing Corporation, the NSCC, only settles whole numbers.
So if the clearinghouse only sees whole numbers, who actually owns the other half of my Apple share?
The broker does. Or, more accurately, the broker owns the entire unbroken whole share. This is what we call the two-tier accounting system.
And this is the dirty little secret of fractional investing.
It really is. It's the illusion of ownership.
Break down these two tiers for us.
Okay, tier one is the real world.
Yeah.
The physical, legal world. The broker goes out to the open market, say the New York Stock Exchange, and buys one single whole share of Apple.
They pay the cash, they take the delivery.
Exactly. That one whole share sits in the broker's master account down at the depository. That is a real hard registered asset.
Okay, that makes sense. So what is tier two?
Tier two is basically just a spreadsheet.
Just a spreadsheet.
It is an internal subledger sitting on the broker's private computer servers. On that spreadsheet, they literally just type out host owns 0.5 of this share and expert owns 0.5 of this share.
So it's just a digital IOU.
That's exactly what it is. It is a derivative claim against the broker's own inventory.
I have heard a pizza analogy used to describe this, and I think it's perfect.
It is the absolute best way to visualize it.
Let's walk through it. Imagine the actual stock exchange is a massive pizzeria, but they have a very strict rule. They only sell whole pies.
Right. They strictly do not sell individual slices under any circumstances.
But you and I are hungry, and we only have $5 each. We can't afford a $20 pie. So we give our $5 to a middleman, the broker.
And the broker takes our money, walks up to the counter, and buys the whole $20 pie.
But he doesn't give us the pie. He keeps it in his own kitchen.
He keeps the pie, and he just writes our names down on a little notepad. Host gets half a pie. Expert gets half a pie.
So I don't actually hold a slice of pizza in my hand. I hold a promise that the broker will give me the financial value of a slice when I ask for it.
You have a contractual right to the nutritional value of that slice. But the restaurant, the stock exchange, has absolutely no idea that you even exist. They only sold a pizza to the broker.
This sounds incredibly fragile because it implies that my entire ownership stake is completely dependent on the broker's internal bookkeeping skills, not on the central market's immutable records.
Yes. And that structural reality leads directly to how the actual trade is executed on the back end. It's a process called aggregation or pre-netting.
Which sounds like something a commercial fisherman does.
It's something a broker does to your orders to make the math work.
Walk us through the pre-netting math.
Let's say a retail broker receives 3 different customer orders in a 10-second window. Customer A wants to buy 0.4 shares, customer B wants 0.6 shares, and customer C wants 1.5 shares.
Okay, so the broker gets those 3 orders on their app.
Right. The broker's software instantly does the math. 0.4 plus 0.6 plus 1.5 equals exactly 2.5 shares.
But the broker cannot go to the New York Stock Exchange and buy 2.5 shares.
Exactly. So they go to the lit market and they buy 3 whole shares.
Roundup.
I buy 3. They allocate the 2.5 shares internally to those 3 customers on their private spreadsheet, and then they keep that remaining 0.5 share on their own books.
As inventory.
As inventory in their remainder bucket.
So the broker is constantly carrying this floating remainder bucket of fractional shares. They are holding market risk.
They absolutely are. They're essentially forced to run a proprietary trading desk just to facilitate these fractional retail trades. And this naturally leads to the next massive mechanic, which is internalization.
Internalization, meaning it stays inside the house.
Yes. A huge percentage of fractional retail trades never actually hit the lit exchange at all.
Because the broker just matches them up internally.
Right. If you log in and want to sell 0.5 shares of Apple, and 10 seconds later I log in and want to buy 0.5 shares of Apple, the broker doesn't send those orders to Wall Street. They just swap our names on their internal spreadsheet.
The order never goes to the NASDAQ.
Never.
It never contributes to public price discovery.
Never sees the light of day. It all happens in the dark, inside the broker's own server room.
Which, on the surface, sounds highly efficient for the broker. But this brings us perfectly into part 3, the risks and trade-offs, the fine print. Because if all these trades are just happening internally and they totally depend on the broker actively aggregating and matching things up, that heavily implies I am not getting the same market treatment as the institutional guy buying the whole share.
You are absolutely not getting the same treatment, not even close. And the biggest, most immediate risk to the retail investor is liquidity constraints.
Liquidity, the ability to sell when you want to sell.
Right. When you trade a whole share, a round lot, you are instantly tapping into the massive global liquidity tool of the entire financial market. You've got Goldman Sachs, Citadel, high-frequency traders, pension funds. Everyone is there to take the other side of your trade.
But when I trade a fraction?
When you trade a fraction, you are often strictly limited to the liquidity provided by your specific broker.
And this manifests in a practice called batching, right?
Correct. Because the broker has to sit there and actively aggregate all these tiny $5 orders to make a whole share block trade economically worthwhile, they often don't execute fractional orders instantly.
They wait.
They batch them up. Some brokers might only execute fractional orders at very specific times of the day. Maybe once at the market open, once at the market close.
Oh, wow. So think about the real world implications of that. If I am sitting at my desk and I see breaking news hit the wire at 10:00 a.m., let's say the CEO of a company I own is suddenly indicted for fraud.
A catastrophic news event.
Right. And the stock chart instantly starts plummeting. It's in free fall. I grab my phone, I open my app, and I furiously hit sell on my fractional position to get out.
You hit sell, and your beautifully designed app flashes a green check mark and says order received.
But I'm not actually out of the stock.
No. Your execution might not actually happen until the broker's dedicated batch window at 4:00 p.m.
So I am just sitting there, completely paralyzed, watching the price drop 10%, 20%, 30% throughout the afternoon, and I am utterly powerless to stop the bleeding.
You are locked in a burning building.
That is a terrifying nightmare scenario for an active investor. And I assume this batching process severely limits the actual types of orders I can place on the platform.
Hugely. This is another major hidden friction. With whole shares, you can use sophisticated risk management. But with fractions, you generally cannot place limit orders or stop-loss orders.
You can't tell the broker, only sell this if it drops to $50.
Usually no. You are almost always restricted to a basic market order. You are effectively handing your shares to the broker and saying, just get me out at whatever price you happen to get later today when you finally run your batch.
In a highly volatile market, that is essentially financial suicide.
It is a massive risk that retail investors accept simply because they don't read the execution disclosures.
Now, there is another risk here that I found really, really disturbing when we were digging into the research for this deep dive. We are calling it the Roach Motel problem.
Yes, transferability.
Where you can check in, but you can't check out.
This is the specific issue that comes back to bite people years down the road when they least expect it.
Let's walk the listener through it. Let's say I have a portfolio. I've been aggressively using a cool starter fintech app for 5 years. I've diligently dollar cost average, and now I have $50,000 sitting in there, all comprised of fractional shares across 100 different companies.
The great nesting.
Right. And I decide I've outgrown the app. I want to move my wealth to a traditional big boy broker like Fidelity or Schwab. So I hit the button to initiate an account transfer. What happens?
You start what the industry calls an AC test transfer, the automated customer account transfer service. This is the central plumbing that securely moves assets between different banks and brokerages.
But the AC test pipes have a specific shape.
Yes. The ACATS pipes are perfectly round. They only fit whole shares. They strictly do not support or recognize fractional share.
So what actually happens to my 0.5 shares of NVIDIA?
The system splits your holdings. The whole shares move through the pipe seamlessly. If you have 10.5 shares of NVIDIA, those 10 whole shares transfer over to your new broker without a hitch.
And the 0.5?
The 0.5 share hits a brick wall. The sending broker, the app you were trying to leave, automatically liquidates it. They force sell that fraction for cash.
Without asking me for permission.
They already have your permission. It is buried deep in the terms of service you agreed to when you downloaded the app. Forced liquidation on transfer.
And here's why that hurts the investor so badly. It triggers an immediate taxable event.
Exactly.
If I meticulously bought that tiny NVIDIA fraction 3 years ago and it has steadily compounded and is now up 200%, my broker just forcefully realized a capital gain that I had absolutely no intention of realizing.
You just generated a totally unnecessary tax bill for yourself. You actively disrupted your long-term compounding. And you just created an absolute nightmare headache for your accountant come April.
But it's not just the taxes, right? There is also the cash drag element.
Right, because that liquidated fraction is now just sitting there as fiat cash. It has to physically transfer between the banks, which usually takes a few days to settle.
And if the overall market happens to rip higher during those 3 specific days, you completely miss the move.
You are sitting in cash. You are out of the market.
So you are effectively trapped in the Roach Motel. If you have a highly diversified portfolio consisting of 500 fractional positions, transferring to a new broker is almost mechanically impossible without blowing up your entire tax strategy.
It creates a massive structural lock-in effect for the broker. The sheer friction of leaving is so punishingly high that you end up just staying with a mediocre broker, even if their customer service declines or they hike their hidden fees.
That is wild. And just briefly, before we move on to the exploits, there are also severe limitations on basic shareholder rights, right? Like voting and dividends.
Oh, definitely. If you hold a fraction, you typically have 0 voting rights. The broker holds the whole share. So either the broker votes it or the vote is just entirely lost to the ether.
You have no voice in the boardroom.
None. And with dividends, it's a game of fractions. Dividends are paid proportionally. But watch out for the rounding trap.
A rounding trap.
Let's say you own a microscopic fraction of a cheap stock and the company declares a tiny quarterly dividend. If the math calculates that your specific proportional payout is less than 1 single penny, say 0.004, the broker system will simply round it down to 0.
You get nothing.
You get absolutely 0, and the broker keeps the fraction of a penny. Multiply that by millions of users and it adds up.
Death by 1,000 rounding errors. Now, I want to pivot to the absolute wildest part of this story. We just talked about all these risks to the end user, but there is also a massive structural risk to the underlying market itself. We have to talk about the corporate action nightmare.
The Roundup exploit.
Yes. This legitimately sounds like a plot from a Wall Street heist movie.
It really does. It is pure, unfiltered arbitrage of the market's plumbing. And it all centers around corporate events called reverse stock splits.
Okay, set the scene for us. Explain what a reverse split actually is.
Usually a reverse split is a giant red flag. It's a sign of extreme corporate distress. Let's say a struggling company's stock price plummets to 50 cents a share. The NASDAQ exchange calls them up and says, hey, your stock needs to trade over $1 or we are going to kick you off the exchange entirely.
Delisting.
Right. So to artificially boost the price, the company executes a 1-for-10 reverse split. Every 10 old shares are forcefully consolidated into 1 new share. The price theoretically instantly jumps from 50 cents to $5.
Simple math. 10 old shares suddenly equal 1 new share. Your total value stays exactly the same.
Exactly. But here is the critical vulnerability. What happens if an investor owns fewer than 10 shares? What if you only own exactly 1 single share before the split?
Well, mathematically, 1 divided by 10 is 0.1, so I should end up owning a 0.1 fractional share.
Right, you should. But historically, a lot of these distressed companies simply did not want to deal with the administrative headache of fractional shares. It's incredibly messy for their corporate registrar to track.
So what did they do?
They would intentionally put a tiny legal clause in the corporate action filing that said, any resulting fractional share from this split will automatically be rounded up to the nearest whole number.
Wait, pause. If I have 1 single share and the math dictates it becomes 0.1, the company just legally rounds my 0.1 up to a full 1?
Yes. Think about the math on that. You originally put in 50 cents to buy that 1 share. The split happens, you're rounded up, you suddenly hold 1 new share that is trading at $5.
I just magically turned 50 cents into $5.
You just generated a guaranteed 1,000% return instantly without taking any real market risk.
Okay, but that is just 1 single share. Who really cares about a $4.50 profit?
Our old guy doing it in his basement doesn't matter at all. But professional traders figured this out. They looked at the plumbing and realized, wait a minute, what if I aggressively open 10,000 separate brokerage accounts?
Oh my God.
And what if I deposit $1 into each account and I buy 1 single share of this dying company in all 10,000 accounts right before the reverse split hits?
They industrialized the rounding error.
They completely industrialized it. There was a very famous, very messy case recently involving a company called Upexi and several others like it. Traders, or highly coordinated Discord groups of traders, opened thousands upon thousands of these micro accounts.
They flooded the zone.
They bought the absolute minimum amount required. The split triggered, and that generous Roundup policy triggered simultaneously across every single one of those thousands of accounts.
So they're literally generating brand new equity completely out of thin air. They are actively diluting the company.
Massive, staggering dilution. In the Upexi case, reports suggest the official shareholder count absolutely exploded overnight. The legitimate, long-term shareholders, the people who actually invested real capital into the business, woke up to find their ownership severely diluted by all these phantom shares that were spawned by a mathematical rounding error.
And the main industry body, SIFMA, is absolutely screaming about this exploit, right?
They are livid. SIFMA is officially calling it a severe market integrity threat. They are sending out urgent memos warning corporate issuers, under no circumstances should you ever do roundups anymore.
Because the fractional system has been gamified.
Exactly. It perfectly highlights the core, fundamental problem we are talking about today. We are forcefully trying to cram a hyper-precise decimal world into a legacy integer system. And the structural cracks are literally big enough for traders to steal millions of dollars through.
Which brings us perfectly to part 4 of the deep dive, the infrastructure crisis. Because this isn't just about clever hackers on Discord or finding weird arbitrage loopholes. This is about the foundational system itself breaking down under the weight of the math.
The deep systems.
Right. We started this deep dive talking about that FINRA mandate, the one that hit this week, February 25, 2026. Why is this specific reporting mandate the ultimate smoking gun?
Because it legally forces a confession from the industry. The six decimal rule requires every retail broker to report their fractional trades to the regulatory tape with extreme six decimal precision.
Okay.
But remember, the ultimate clearinghouse, the NSCC, the base layer of the market, still cannot handle that precision. They only accept whole integers. So what brokers are being forced to do right now, every single day, is file a bizarre, contradictory report.
What does the report look like?
It's a report that essentially says to the regulator, hey, I just executed a retail trade for 2, 1, 2, 3, 4, 5, 6 shares of Apple, while simultaneously settling a corresponding trade with the central clearinghouse for 0 shares.
Or 1 share.
Right, 0, 1.
The report explicitly documents the discrepancy.
It officially documents the air gap. It is providing a daily, quantifiable measurement of exactly how much of the United States equity market is currently running on private, internal broker ledgers rather than the secure central clearing mechanism.
It is publicly exposing the sheer scale of this IOU economy.
Exactly. And the timing of this mandate is incredibly critical because the market is actively accelerating.
Right. The settlement times are compressing.
We recently moved to T+1 settlement, which is now the industry norm. Everyone expects trades to settle the next business day. But now, regulators and institutions are aggressively pushing for T+0 same-day continuous clearing.
And we are also talking about the shift to 24/5 trading, right? Where the stock exchange literally never sleeps during the work week.
Yes, the NSCC 24/5 clearing initiative is slated to go live in June 2026. And this time crunch is exactly what keeps institutional risk managers awake at night staring at the ceiling.
Because they are losing their safety buffer.
They are losing their most valuable asset, time. In the old days, and by old days I literally mean like 3 years ago, we had a luxurious T+2 settlement cycle.
Yeah.
We had these massive, quiet overnight batch cycles.
Where the computers just hummed along in the dark.
Right. If the broker's back office reconciliation team found a fractional error at 6:00 p.m., if they noticed, hey, our internal spreadsheet says we owe our clients 100.5 shares of Tesla, but the DTCC vault says we only actually have 100 whole shares. They had all night to figure it out.
They could investigate. They could call the trading desk.
They could make manual spreadsheet adjustments, buy the missing fraction at the morning bell, and fix the ledger before the client even logged in.
And now,
with the relentless push for continuous net settlement and 24-hour nonstop trading, that quiet overnight window is permanently gone. There's no overnight anymore. There's absolutely no time to manually fix the spreadsheet.
So if a broker's internal fractional ledger gets out of sync with physical reality, and the market is moving fast,
the risk compounds instantly. There is no circuit breaker for bad accounting.
Let's follow that dark path for a second. What if a broker actually fails? What if a mid-sized brokerage somehow goes completely bankrupt at 3 a.m. on a Sunday morning during 24-hour trading?
That is the ultimate test. And your ownership of your fractional assets, which remember is just a digital line item on their internal server, not a hard record at the central depository, that represents a very, very different bankruptcy resolution process than if you owned a whole registered share.
You are an unsecured creditor basically fighting for scraps on a spreadsheet.
You are stepping into a realm of deep legal uncertainty that most everyday retail investors simply do not appreciate when they buy $5 of stock.
It really sounds like we are building a massive, gleaming digital skyscraper on a foundation of wet sand.
We are building a hyper-fast digital 247 skyscraper directly on top of a foundation of 1980s mainframe batch processing code. And the cracks are showing.
Okay, we have definitely scared everyone sufficiently with the plumbing talk. I want to pivot to the opportunity.
Let's do it.
Because clearly, millions of people are using this infrastructure. And it's not just 20-year-old kids playing with $50 on their phones. Very wealthy people, the smart money, are actively using fractional shares for highly specific strategic reasons.
Yeah, absolutely are.
So part 5 is about these strategic use cases. Why do the pros use fractions?
The biggest, most impactful use case by far is a strategy called direct indexing. This is honestly the killer app for fractional shares.
Define direct indexing for the listener.
Historically, direct indexing was an elite tax strategy strictly reserved for ultra-high net worth individuals, people with $10 million or more. But now, purely thanks to fractional shares, you can execute it perfectly with a $50,000 account.
But explain the actual mechanics of it. Why wouldn't I just go buy SPY? The standard S&P 500 ETF. It's cheap, it's incredibly easy, it tracks the market. Why complicate things?
Because the standard ETF is basically just a wrapper. Think of it like a prepackaged lunchbox. You have to eat exactly what is inside the box.
Okay.
If the overall S&P 500 goes up 10% for the year, your ETF goes up 10%. You eventually sell it, and you pay your capital gains tax on that 10% profit. End of story.
Very simple.
Very simple, but highly inefficient for taxes. With direct indexing, you do not buy the prepackaged ETF. Instead, you use an algorithm and fractional shares to directly purchase all 500 underlying companies in the index individually.
That sounds like an absolute logistical nightmare for a normal person to manage. 500 different stock positions.
You don't do it manually. Specialized software does it for you in the background. But here is the absolute magic of owning the pieces instead of the box. Tax loss harvesting.
Explain how that generates alpha.
Let's look at a realistic market year. The S&P 500 index as a whole is up 10%. But inside that index, under the hood, there is massive divergence. There are huge winners and huge losers.
Right. NVIDIA might be up 50%, but maybe a legacy oil company like Exxon is down 10%.
Exactly. If you only own the SPY ETF, the massive gain from NVIDIA completely masks the loss from Exxon. You cannot isolate and extract that loss to help your taxes.
But if I direct index,
If you own the individual stocks directly via fractional shares, your software can automatically sell those specific Exxon shares that are down.
you purposefully realize the loss.
You realize the loss on paper, and the IRS lets you use that specific capital loss to directly offset capital gains elsewhere in your broader portfolio, which actively lowers your overall tax bill for the year.
But wait, if I sell my Exxon, then my portfolio is totally out of whack. I'm not properly invested in the energy sector anymore. I've drifted away from tracking the S&P 500.
That is a brilliant trick of the algorithm. You sell Exxon to harness the tax loss, and the software immediately turns around and buys Chevron, or a highly correlated energy ETF.
So you seamlessly maintain your broad sector exposure.
You maintain your exact correlation to the index, you still get the market returns, but you essentially bank that tax loss to use against your gains.
That is what the industry calls tax alpha.
Yes. And rigorous studies suggest this relentless harvesting process can easily add 1% or more to your actual after-tax returns annually.
Which doesn't sound like a lot to a day trader, but compounded over 20 or 30 years.
It is hundreds of thousands of dollars. It is huge. And here's the kicker. You can only execute this strategy efficiently with fractional shares.
Because buying 500 whole shares is too expensive.
Right. If you had to buy whole round lots of all 500 S&P companies to get the exact proper market weighting, you would need millions of dollars in liquid capital. But with fractional shares, a computer can perfectly replicate the exact weightings of the S&P 500 for you using literal pennies.
You can own 0.0002 shares of Microsoft and 0.0001 shares of some regional bank to make the math perfect.
Exactly. It democratized high-end tax management.
So fractional shares are essentially a power tool. You can use them to expertly build a beautiful house with direct indexing, or if you aren't paying attention to batching and liquidity, you can completely cut your leg off.
I think that is a very fair and accurate summary of the landscape. They allow for incredible precision. And speaking of precision, ETF efficiency is another massive use case for the pros.
Just putting every single dollar to work.
Right. Let's say you contribute exactly $500 to your IRA. If the specific ETF you want to buy currently costs $400 a share, historically you would buy one share and you would just have $100 of cash drag sitting idle in your account doing absolutely nothing.
Just losing value to inflation.
With fractions, you just buy 1.25 shares. You invest 100% of your capital instantly. It is mathematically perfectly efficient.
Okay, before we start to wrap this up, I do want to touch on the broader global context here, because our audience at Talk Tickers is highly global.
We have listeners everywhere.
Right. So if you are listening to this deep dive right now, sitting in London or Frankfurt or Sydney, does this plumbing crisis actually apply to you?
It definitely applies, but the regulatory labels they use are very different. And honestly, the underlying risks might actually be significantly higher depending on your jurisdiction.
Why is that? What is happening in Europe?
Europe is currently trapped in a very intense regulatory tug-of-war regarding fractions. The primary European markets regulator, ESMA, is genuinely struggling to clearly classify what a fractional share actually is under the law.
Wait, how is it a debate? It's a piece of a stock.
Well, in the US, as messy as our plumbing is, the SEC generally treats these fractions legally as securities. But in Europe, there is a very strong ongoing legal argument that fractional shares are not actually equities at all. They are arguing that they are derivatives.
Like a CFD. A contract for difference.
Exactly like a CFD. And if the regulator officially classifies your fractional ABL share as a derivative instrument, that changes absolutely everything about your investment.
It changes the entire legal framework.
It changes the strict reporting requirements for the broker. It completely changes the required investor protections and risk warnings. But most importantly, it fundamentally changes your legal status in the event of a brokerage bankruptcy.
Explain that difference.
If you own a registered security, it is legally your asset. It is held in a segregated client account. If the broker goes under, that asset is still yours. It is protected.
But if it's a derivative?
If you own a derivative contract, you do not own an asset. You are simply a counterparty to a bet with the broker.
So you are basically just an unsecured creditor.
You are relying entirely on the financial solvency of the house. If the house goes bankrupt, your contract is likely torn up, and you are standing in line at bankruptcy court hoping to get pennies on the euro.
So you're effectively betting against the house without realizing it.
Yes. So if you are an international investor actively trading fractions, you really need to dig into your app's terms of service today. Does the legal document specifically say you own a share? Or does it use the word contract?
That is an absolutely terrifying legal distinction to hide deep in a PDF fine print.
Read the terms of service is obviously the most boring advice anyone can give on a financial show. But in this specific case, it literally determines whether you securely own an asset or if you just hold a risky bet.
We have covered a truly massive amount of ground today.
We went deep into the weeds on this one.
We really did. We've gone from the velvet rope and the extreme pricing of Berkshire Hathaway to the bizarre pizza slice internal ledgers of the modern retail brokers. We've looked at the Roach Motel of forced taxes during ACATS transfers, and we broke down the literal heist movie mechanics of the Roundup exploit.
It's a lot for anyone to process. The plumbing is not simple.
It's not. But we always like to leave the listener with something highly actionable, one specific thing they can do immediately after finishing this deep dive. We call it the one question.
And for this topic, the one question is absolutely critical to your long-term wealth. If you actively invest your money using fractional shares, or if you are even just casually considering transferring your current account to a new brokerage this year, there is exactly one question you must ask your current broker right now.
What is the question?
Send their support team a message, dig through the FAQ, or literally just call them on the phone and ask this exact phrasing. If I initiate an ACAPS transfer of my entire account to another brokerage tomorrow, what is your firm's specific policy on my fractional lots? Do you forcefully liquidate them? And if you do, exactly how is the final execution price determined for those forced sales?
Why is that specific execution detail the ultimate question here?
Because UI convenience is free at the entry point. The app makes it so unbelievably easy and fun to swipe up and buy your stocks, but the true heavy cost of that convenience is entirely hidden at the exit point.
They trap you at the door?
High friction exit costs, unwanted forced tax events, obscure liquidity traps during batching windows. That is the actual hidden price you pay for the magical ability to buy exactly $5 of Amazon whenever you want.
You essentially need to know if you are actively building a highly portable, resilient wealth portfolio, or if you are just building a beautiful walled garden that you can literally never leave without paying a massive penalty.
And that ties perfectly back to what we said at the start. Investing at its core is entirely about ownership.
Right, and if you can't freely take your property with you when you want to leave, do you actually own it?
That is the fundamental philosophical question of the fractional era. The further you get away from holding the actual whole registered share, the more layers of digital abstraction you're adding to your money.
And as we've seen today in the financial system, risk always lives in the layers.
Always. Use the fractional tools because they're incredibly powerful for things like indexing, but absolutely make sure you understand the underlying machine that runs them.
And keep a very close eye on those 6 decimal places FinNR is tracking. They might be telling you a lot more about the health of the market than you think.
Absolutely. The data is going to be fascinating to watch over the next few months.
This has been Talk Tickers. Thank you for joining us for this deep dive, and we'll see you next time.